If I had to start investing from scratch in 2026, I would not just blindly put all my money into the S&P 500. And that might surprise you, because for decades, people have said that simply investing in the S&P 500 will make you rich over the long term. And to be fair, historically, that has worked. The index has delivered around 8 to 10% average annual returns over the last 100 years. But the question is, will it continue to work the same way in the future? Because the market today is very different from what it used to be. In recent years, a large portion of the S&P 500's returns has come from just a handful of companies, mostly driven by artificial intelligence and big tech. Companies like NVIDIA, Microsoft, and Apple have been responsible for a significant share of the growth. According to institutions like Goldman Sachs, market concentration is now close to historic highs, which means a small number of companies are driving a large percentage of returns. So if you are investing blindly into the index today, you may actually be putting a large portion of your money into just a few companies. And if those companies slow down, your overall returns could slow down as well. Now let's zoom out and look at the bigger picture. The global economy is changing. For decades, the United States has dominated global markets, but that may not remain the case forever. Emerging economies are growing rapidly, with countries like India, Brazil, and China increasing their share of global economic output. According to the International Monetary Fund, emerging markets are expected to drive a significant portion of global growth in the coming decades. So if I were starting my investing journey in 2026, I would take a more balanced approach. Instead of relying on just one country, I would invest in a global or world index fund that gives exposure to the United States, developed markets, and emerging economies. This way, I still benefit from innovation in the US, but I also capture growth from the rest of the world, while reducing the risk of being overexposed to a small group of companies. Because investing is not just about following what worked in the past. It is about adapting to how the world is changing. The S&P 500 is still a powerful investment, but in 2026, diversification matters more than ever.